Another ratio which is used to calculate the liquidity position of an enterprise is called as liquid ratio. Now students, liquid ratio is also called as acid test ratio and quick ratio as well. That means this ratio has got two other names as well. Liquid ratio is one of the names, the other one being acid test ratio and quick ratio. Now this ratio gives an indication of how fast a business can convert its resources or the current assets into cash. Now by calculating this ratio, we actually want to ascertain the ability of an enterprise to pay off its current liabilities in a very short term period. Remember, by short term period we mean less than 1 year, but very short term means about less than 3 months. So this ratio tells us about the ability of an enterprise to pay off its current liabilities if required within a very short term period, that is less than 3 months. So the formula for calculating liquid ratio is liquid assets upon current liabilities. And in place of liquid assets, we can always place quick assets. We all know what current liabilities are, that is liabilities which have to be paid within 1 year. But what about liquid assets? Those assets which can be readily converted into cash, that is a time period of less than 3 months. So liquid assets are defined as the ones which can be readily converted into cash, and they can be calculated by deducting inventories and prepaid expenses out of your current assets. That means liquid assets are equal to current assets minus inventories minus prepaid expenses. Again, the current liabilities can be calculated in the same manner as in current ratio. Coming to ideal liquid ratio. Now, as a rule of thumb, ideal liquid ratio is taken to be 1:1. By 1:1, we mean that the current liabilities are equal to liquid assets. That is, in any particular firm, in any given situation, our liquid assets should be equal to current liabilities.